Remember the early 2000s? The American dream felt closer than ever. Home prices were soaring, and it seemed like they would never stop. Banks were handing out mortgages like candy, even to people with less than perfect credit. These were called subprime mortgages. Now, you might wonder, why would banks take on such a big risk? Well, that's where the financial alchemy began. They took these risky loans, chopped them up, and bundled them into complex financial products called mortgage-backed securities, or MBS, and collateralized debt obligations, or CDOs. Credit rating agencies then slapped a triple-O rating on them, the safest investment grade possible. Investors from all over the world bought them up, believing they were holding solid gold. Everyone was convinced that the housing market was a one-way ticket to wealth. The problem? It wasn't. By 2006, the party started to wind down. Interest rates began to climb, and suddenly, millions of homeowners with adjustable rate mortgages found their monthly payments skyrocketing. They couldn't keep up. Defaults surged, and foreclosure signs started popping up on lawns across the country. As more and more people lost their homes, the housing market, which everyone thought was invincible, began to crumble. Those supposedly safe tripola investments, they weren't safe at all. Their value plummeted practically overnight. Banks and financial institutions holding trillions of dollars worth of these toxic assets started to bleed money. The entire global credit system, the very lifeblood of the economy, seized up. Then, on September 15, 2008, the unthinkable happened. Lehman Brothers, a 158-year-old investment banking giant, filed for bankruptcy. It was the largest bankruptcy in U.S. history, and it sent a tsunami of panic across the entire global financial system. The collapse of Lehman Brothers was the tipping point. The dominoes began to fall fast. Businesses, large and small, suddenly couldn't get the loans they needed to operate, pay their employees, or invest. Fearing the worst, consumers slammed their wallets shut. Spending ground to a halt. The consequences were devastating. In the United States, nearly 9 million jobs vanished. The stock market crashed, losing over 50% of its value. Home prices, the very foundation of the crisis, collapsed by almost 30%, wiping out trillions in household wealth. This wasn't just an American problem. The shockwaves hit Europe hard. Major banks there also teetered on the brink of collapse, triggering a severe debt crisis that would plague the Eurozone for years. The global economy was staring into the abyss. It was the worst economic downturn since the Great Depression. With the entire financial world on the verge of total collapse, governments and central banks had to act. And they had to act fast. The U.S. government unleashed a series of unprecedented rescue programs to prevent a complete meltdown. First, there was the Troubled Asset Relief Program, or TARP, a massive bailout fund to inject capital into failing banks and stabilize the system. Then came huge stimulus packages designed to jumpstart the economy by funding infrastructure projects and providing tax cuts. Meanwhile, the Federal Reserve, America's central bank, took its own emergency measures. It slashed interest rates to near zero, making it incredibly cheap to borrow money and launched emergency lending programs to provide a critical lifeline to banks. These were controversial, monumental decisions, but they slowly managed to pull the economy back from the brink. The system stabilized, and by 2014, the job market had finally recovered to its pre-crisis levels. So, when the dust settled, what exactly went wrong? Post-crisis investigations pointed to a perfect storm of failures. A major culprit was weak regulation. The rules governing the financial industry had become too lax, allowing banks to take on enormous unchecked risks. This was fueled by a culture of excessive risk-taking, where the pursuit of short-term profits overshadowed any sense of long-term caution. The credit rating agencies, the supposed independent referees, completely failed. They gave their highest ratings to junk assets in exchange for fees, misleading the entire world. A huge part of the problem also came from the shadow banking system, non-bank financial institutions that operated outside of traditional regulations. And perhaps the most dangerous element was the widespread, almost religious belief that housing prices could never fall. This collective delusion inflated the bubble to catastrophic proportions. In response, the U.S. passed the Dodd-Frank Act in 2010, a sweeping set of new rules designed to rein in Wall Street and make the financial system safer for everyone. The 2008 financial crisis was a brutal lesson in how interconnected our modern world is. It showed how a bubble in one country's housing market could trigger a global economic earthquake. It reminded us that robust regulation and responsible lending aren't just bureaucratic red tape. They are the essential guardrails that protect all of us from financial disaster. Because when the system cracks, it's not just the bankers who feel the pains. Everyone. It's our jobs, our savings, and our futures that are on the line. Thanks for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into the events that shape our world.